Hello, everyone. Today on the final bar, welcoming on Tony Dwyer from Canaccord Genuity. Tony's coming back on the show to share a fantastic chart that I think tells the story of the liquidity environment that we're in and what tends to happen over the long term in the coming weeks and months afterwards. We're also going to talk about this market reacting pretty favorably to the upside after yesterday's distribution. What does this mean for the long-term trends? Where are the opportunities? Also answering your questions from the final bar mailbag. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at the markets together through the lenses of technical analysis, behavioral finance, sentiment, psychology, trend, momentum, all the tools we have available to really understand what investors are thinking, what they're feeling, and how they're expressing those emotions through price. Usually coming to you from outside of Redmond, Washington. Yesterday and today, we're actually doing this. I'm doing this remotely. I'm up with my family up in the San Juan Islands, which is a really pretty area that I hope none of you come to because we'd like to keep it pretty lightly traveled because the ferries are tough enough to navigate on their own. But appreciate you sticking with us as we continue to do the show from a unique and remote location. A lot of really fantastic events coming up on StockCharts TV in the coming weeks and months. As I mentioned, I have Tony Dwyer on my show today from Canaccord Genuity. Remainder of the week, we have Chris Shavacco joining us from Shavacco Capital. Also, Mary Ellen McGonigal joining us from the MEM Edge. This week is a very special week all across the board on StockCharts TV called Charting the Second Half. We've been planning this for months now, and our StockCharts TV team has done a really good job getting ready for it. There have been some amazing presentations so far this week. Martin Pring gave his second half of the year outlook. Rick Bensinger, who was on my show yesterday, gave his outlook earlier today, and Tony will also be sharing an outlook later this week. And the entire week's presentations will culminate in our Market Outlook panel, which is coming up this Saturday. That's at noon Eastern and 9 a.m. Pacific. And that's basically moderating a group of 4 talented strategists giving their take on the second half of the year. It's going to be an interactive live panel. So you'll be able to go call in on StockCharts TV right on our website and ask questions directly from the panelists as we're going. So it's going to be a really rare opportunity to pick the brains of some really sharp analysts and how they're approaching a very uncertain second half to 2020. Let's get right into our market recap. So on the markets today, the S&P certainly finishing more in a position of strength rather than weakness. Opened weaker in the morning, and then from about 11 a.m. on, it rallied pretty well. Actually, from about 10:30 on, actually, it was just a nice uptrend. So the S&P finished just below 3,200, so around 3197, 3198. That's up 1.3%. So again, that's coming from a pretty elevated drop off yesterday. So yesterday we closed down and sold off aggressively going into the close. That sort of continued this morning. We didn't retrace 100% of the way, but certainly chipped away back on the upside. That's not super surprising. Again, all else being equal, after a big distribution day, you'd expect at least a bounce back. So the question now is this the beginning of further recovery, as yesterday was an aberration of sorts, of potential downside, or is this the next leg before some further downside? We're going to look at the trends together on some of the longer term charts here in our recap. So the S&P finishing up about 1.3%. Technology actually had been at the bottom of the list for much of the day. Actually finished more in the middle, about a market perform by the end of the day. So sort of recovered as there's a bid that came in for big tech shares that had been down out of the open. The NASDAQ 100 finished up 0.8%. What's interesting here is small and mid caps outperformed the S&P today. It's one of the question marks, I think, for this overall environment is just the underperformance of small cap, the relative weakness of small caps and mid caps, not just in terms of price, but also in terms of the breadth characteristics. We're going to look at that chart a little later in the show. And again, it's just generally indicating relative strength in the mega cap trade and tech, consumer, communication services, relative weakness in small and mid caps. And is that a downside? On an average bull market cycle, yes, that would be sort of a problem. I think weakening breadth in general is not an ideal situation. Having said that, we're sort of in this nifty 50 narrow leadership environment, and an uptrend can last very long with that in place. The VIX went back below 30. It's around 29.40 after all said and done today. Bonds stronger, so they actually opened up pretty strong and came off a little bit, but still finished just a little bit of rounding error above yesterday's close. 10-year yields down around 62 basis points. On the commodity side, gold finished stronger, actually toward the highs of the day, up about 0.5%. Let's look at a chart of the S&P, how things sort of netted out today. So as we've talked about, the overall environment in stocks has been sideways, even though the underlying trend, the primary trend, what I would call the main trend after the March lows, has been positive with a couple, fits and starts. We've had a fairly consistent pattern of higher highs and higher lows. And now the real question is, are we able to eclipse that previous swing high, which on the weekly chart is what you're really looking at, that high from the first week in June. So the S&P really needs to get around 3250 to complete that. What's interesting is yesterday we got right up to that level and sold off, obviously aggressively into the close. Today we retraced about half of the way back up to that level. Again, I'd want to see the S&P above 3250, which would put us above the June high. That would clear the way, I think, with very little doubt, with little reservation. I'd expect the S&P to get back to 3,400 and continue this uptrend until we see a lower high, a failure at a high, until we see a lower low, where we start to break down through some of these swing lows. We're still overall in an uptrend, and in the short term, the tactical read is in a sideways congestion range, and that's how I'm thinking of it. On the upside, you have 3230 to 3240. On the downside, you have 2970 to 3000, sort of this range, the lower end of this this pennant pattern that we saw in June. And overall, we're in the upper end of this range. So we find resistance, we sell back to the lower end, or we break higher. And I think whichever way that happens, that certainly tells you a lot about the direction of momentum and the potential of the S&P to retest highs or to start aiming more at some of the previous lows that we've seen coming up until the last couple of months. In terms of other themes to pay attention to, energy actually up pretty significantly today, with the XLE leading the way higher, 3.5%, followed by materials and industrials. Materials is actually a really interesting sector. It's a relatively small sector. It's just a couple percent. So relative to something like tech or consumer discretionary, it's a very small weight in the S&P. So it doesn't have a huge implication for the overall market. But it's interesting when a sector like XLB starts to do really well, because I think a lot of people tend to write it off. You don't think a lot about gold stocks necessarily. You don't think about aluminum names, some of the names that might be in materials, chemical names, for example. So, looking at some of those groups and the industry summary page, looking at the scooter rankings by group is a really good way to focus on what's working and what isn't. Having not looked at them in a couple of days, I wouldn't be surprised if gold stocks and mining stocks are still at the top of the list of materials as a sector, and certainly helping the case with gold continuing to appreciate. On the downside, you have financials, the least participating in the upside today, up 2/3%, followed by utilities, and then consumer discretionary. It's actually pretty interesting to see it down here with some of the defensive plays and value plays that underperformed today. So consumer discretionary rotating down to the lower end of the list today. Interesting to note, and I had some questions on eBay recently. I just wanted to point out eBay in the top 10 is actually the number 2 stock below Tesla. So the top 5 names have actually fluctuated, similar names, but they've all reshuffled a little bit. So it's worth noting the number 1 scooter ranked stock is still Tesla, after obviously an exponential rise, followed by eBay, which has obviously had a lot of strength. Then we go into semiconductors with NVIDIA, back to Amazon as number 4, and then DXCM, which is a stock that actually came up from the mid-cap space, actually grew into to join our large cap ratings maybe a couple months ago, and has consistently been number 1 or number 2, is still in the top 10 but coming off. But what strikes me is just the number of mega caps in this top 10 list. And it's big names like Amazon, like Netflix in the top 10. That just speaks to weight of those big mega cap names. We're going to look at the consumer discretionary to staples ratio, which has fluctuated a little bit, and the strength of Amazon has certainly skewed things a little bit versus the equal weighted version of it. In terms of industry leadership, renewable energy was actually number one, up 9%. Interesting to see home builders in the top 10. This is home construction up 4.5%. I mentioned with the materials, aluminum. I hadn't looked at this yet, but I'm seeing now aluminum up 7.8%. Gold stocks up 3.7%, and mining stocks as well. So 4 of the top 10 are with them in the materials sector. Interesting to see a healthcare group up here as well. And, healthcare has been something I think a lot of people have been, it's been sort of a question mark. We looked at it on the longer term chart yesterday. And certainly, you're seeing huge resistance overhead, but a nice bullish engulfing pattern in the medical supply group with potential to head a little higher. On the downside, apparel retailers, one of the consumer discretionary groups in the bottom 5, also gambling, rec services, broadline retailers. That's some of the big box stores in there. So, a lot of consumer discretionary in the bottom 10, which is why the sector felt a little heavy, and banks actually one of the worst 10 as well. So an interesting day actually with a nice rally. I mean, it's certainly a nice recovery from yesterday's sell-off. Again, I still think we're in a range. I don't think that thesis has changed. I'm still seeing a lot of the same issues that we've seen in terms of the breadth being weaker the further down you go in the cap tiers, and the question mark that remains with narrow leadership mega cap names really driving things higher. Again, that can go a lot longer than you'd expect, which tells me to continue to focus on the trends and how they're evolving. We need to take a quick commercial break. We'll be back with my guest, Tony Dwyer. We'll see you in a minute. Hey everyone, welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us for the final bar every weekday after the close. As a reminder, we're going to do a mailbag segment a little later in this show, and you can get questions to us at any point 2 ways. One is via email, thefinalbar@StockCharts.com. Second way is on Twitter. Just tag us in a comment at FinalBarSCTV. We've gotten so many great questions, and it's been a pleasure to hear from a lot of you about what we could do better with the show, but also especially questions that you're running into as you're using the charts, as you're trying to understand the markets, as you're looking at particular ETFs or stocks or whatever it is. Please send your questions our way, and we'll do our best to get to as many of them as we can on the air. Want to welcome on my guest, Tony Dwyer, back to the show. Tony's the strategist at Canaccord Genuity in New York. Tony, pleasure to have you back on, my friend.
Always great to be with you, David. Thank you.
So the first chart that you sent, we were talking about this before we started. I think it tells such a powerful story about the conditions that we are part of. Tell us about what this means for liquidity here.
Well, what we know is there is excessive liquidity out there. So what really changed the whole game for me, and I think a lot of other people, and they didn't even know it at the time. I was watching the show and it hit me like a ton of bricks. I was watching with my wife. It was the CBS 60 Minutes show where Jerome Powell came on air and was being interviewed. The interviewer on 60 Minutes asked him about quantitative easing. He said, we're printing money. Dave, he literally used the term, we're just printing money. Right? In my 35-year career, I never imagined. When I came into the business, Alan Greenspan, every time they would ease, within the next 5 seconds, he would say, but you can't have the deficits too big because it's unsustainable. And don't worry, we're going to stop easing at some point. Jerome Powell got on 60 Minutes, Dave, and he said, we're printing money. The anchor looked at him and said, well, what's going to happen down the road? And he goes, now is not the time to worry about that. Today, it was reinforced by another Fed governor, Brainerd, who said that we have to move from a policy of stabilization to a policy of accommodation. People keep trying to figure out the game plan. The Fed is telling us the game plan. So if we can get by what's right or wrong, good or bad, don't think it's right. I don't think it's good down the road. It is what it is. And this chart shows you the difference between when you add up money supply, which means the money, basically the money in your bank account, add the equity and bond mutual funds and ETFs. So what we're looking at here on the bottom half of this slide is the difference between liquid money, things that you have or could sell really easily and quickly in any environment, against the kind of money you need for economic activity, which industrial production growth rates, plus inflation. And what you see is we have never been close to this level of excess liquidity. This means that you have excess money above what you need for economic activity. Well, Dave, what do you think that money's going to do? Doesn't figure out if it's right or wrong, good or bad. It's looking for a return.
That's right.
And that has been the driver. And we keep the environment going into from mid-March into the March low, when we were still pretty cautious. There were three things that were hitting the tape. You had, number one, COVID-19. You had no idea what the hell it was and what you're going to do about it. You had an economic shutdown with no do. Well, guess what, Dave? We know what the Fed is going to do.
Yeah. It's such an interesting chart, and so it begs the question, right? And I'm sure this is what most people would follow up with is so how do you know how does this end, or what would you be looking for? Because this certainly seems to be a huge tailwind for upside for equities. You shouldn't be worried, but where would you look for? What would you be looking for that would tell you things are going to change and you need to be cautious?
Each peak comes off of a major economic slowdown. So the initial thrust higher in that red line on the bottom is the incredible amount of money supply. It typically happens in a recession or a very sharp slowdown. 1995, the first half of 1995 saw 0.5% GDP growth. So basically, comment, Dave, is that first surge higher that lifts the market off of its recession-based low comes from an incredible amount of excess liquidity going into the market. What makes it drop, which creates that much more significant upside, is because economic activity improves. In other words, the red line starts going down because industrial production begins to ramp up and grow faster than money. So your first move off of a recession-based low is, okay, what's the Fed going to do? That's I don't want to say always. It's damn close to always. Your first lift off the low, it certainly was this time. The next, then you go into a consolidation pattern, which we've been in, as you noted, and that we're still in. And you see it after all these arrows. You see a consolidation period, right? Sure. So when that happens, that's when you get that the economic activity begins to pick up when everybody starts talking about a double dip.
So we only have about 30 seconds left, Tony, but I did want to get to your second chart because we talked a little bit about breadth conditions and how they're evolving. What's your take on breadth and what that means for the health of this bull market?
Dave, that S&P chart you showed where you had the pennant and then the breakout to the upside, the way I read that chart, you go from 2950 to 3200. That's your range, your spread in that pennant. And then, so that should get you up around 34 to 3,500 just on that technical read. That's technical analysis 101, some of which you taught me. This chart is about the same formation. It's doing the same thing as the S&P. You're in this pennant formation. It's basically showing you, this StockCharts.com shows you that you've done nothing since June 5th. We found that thrust higher you got, if everybody remembers, way back when, in mid-May, you had, by early June, you had more than 90% of the S&P 500 trading above their 50-day moving averages for 10 consecutive days. The prior 5 occurrences that we found from that, you got exactly what you're getting now, a consolidation period. So we've been expecting the consolidation. Likely what it's doing is pulling forward second wave fear, because we're getting it, and political fear later in the summer because we're getting it with the Biden lead. So we're looking for a resolution of the upside of this pennant formation in the cumulative advanced decline line on the S&P.
It's a great take, Tony. And the discussion about liquidity is fascinating and it makes a ton of sense. I really appreciate you coming back on the show. Stay safe and we'll talk to you again soon, all right?
It was great to be here. And just real quickly, Dave, it's the NYSE cumulative AD line, not the S&P.
Yep, right. Okay, perfect.
All right, thanks, buddy.
Thanks, Tony. It was Tony Dwyer from Canaccord Genuity. And again, you talk about don't fight the Fed, and Tony tends to bring beautiful charts that tell the story as to why you need to pay attention to some of these macro factors. And I think his chart of liquidity, boy, it's hard to think about fighting that, and with the market going down meaningfully with that as a tailwind to further upside. It's a lot to think about. I want to get on to my next segment, which is the Final Bar Mailbag, answering some of your questions. I did want to start, though, with a poll that we asked you recently on StockCharts TV. On what time frame do you tend to operate as an investor? And I gave you 4 choices. Very short term, meaning a couple minutes to a couple days. Short term, a couple days to a couple weeks. Medium term, a couple months to a couple years. Or long term, 3+ years, much longer term. 40% of you said short term. You're looking out a couple days to a couple weeks. 32% of you said a couple months to a couple years. Smaller numbers on both sides of the end of the list there, with 17% of you saying very short term, looking really that swing trading type of period, a couple days at most, and then 11% of you very long term, looking out 3+ years. So I asked this question for 2 reasons. Number one, I'm not surprised by the responses. And I think my main goal for asking you this, number one, is to help you answer in a certain way. What I hope you can do as an investor is remember, what is the time frame I'm actually trying to operate on? Because I find a lot of people say you're a long-term investor, and then I look at some of the charts that you're looking at, and I think, if you're a long-term investor, you're looking at the wrong charts, because you're looking at way too short-term of information, right? You're looking at daily movements when you should be thinking more about months and years, or the opposite, right? You're trying to play short-term. You're looking at charts that aren't in line with your horizon. So that was question number one. Question number two is to remind you, regardless of which one of those you answered, remember that all those other time frames are impacting your ability to execute on your own time frame. So if you were a short-term investor looking at a couple days to a couple weeks, remember there's a very short-term time frame that's going to fluctuate and cause, impact your ability to get filled at certain levels that you want. You're also part of that longer-term structural cycle of 3+ years, business cycle, economic cycle. So, use charts to help you understand all of those time frames, but focus your decision-making on the time frame that is really of interest to you. Thanks for answering that poll, though. There's some interesting answers, and I hope it hopefully made you think just a little bit. Let's get to our Final Bar Mailbag. Question number one, we looked at the scooter rankings earlier. How can I find the Russell 2000 components so I can do a chart ranking, ranking them in terms of their scooter rankings? It's not in a predefined group. Oh, yeah, right. So I had mentioned some of the ways to get to create a chart list, and if I have a list of ETFs or something, what you can do is put them in a chart list. So for example, this is global ETFs, and what you can do is say, all right, I want to look at this list, and you can put them in a summary table, and then it sorts it automatically by the scooter ranking, or you just click on the headline to do that, or the header. And what it does is you can immediately see what's up the most and down the most based on that scooter ranking. The way you create that list is by going to your dashboard, by creating a new list, and then saying you want to import members of a group or of an index. But we don't have the Russell 2000 because 2000 stocks is too big for our chart list platform. So here's what you do. Go to Charts and Tools, and then you'll see a selection on the right called Scooter Reports. We have pre-canned reports. This is actually based on the universes we use to categorize different things. So these are the 8 different scooter rankings that we do. So for a US-based investor, these top 5 are going to be the ones you're focusing on. If you look at US ETFs or small cap stocks, this is going to bring in the entire small cap universe sorted by scooter ranking, and you can manipulate them from there. So that's the way that I would look at small cap stocks and find ones based on scooter ranking. You can also obviously use our screening tool and screen on scooter rankings as well. Next question, there's been a lot of recent discussion regarding potential returns in emerging markets. I'm going to summarize your question here. I don't know a lot about currency markets or trading. I'm familiar with the DXY. I know that's a broad index. Can you talk about the role or risk associated with currency exchange rates in relation to investing in emerging market ETFs, trading on American exchanges? That's such a meaty and very good question. I'll try to be as brief as possible. And boy, maybe I could write a blog post or something getting into a little more detail on it. So here's the way to think about it. And I don't know if there's necessarily a right answer, but I'll tell you some of the ways that you can think of it. Option number one is just to ignore the currency impact altogether. Because here, right, you're looking at stocks or companies that are, operating in the emerging markets. There's a currency impact, because a stronger or weaker dollar is going to impact emerging markets because it affects what those returns mean for you as a US based investor, denominating your portfolio in US dollars, because you have to turn that back into dollars at some point so you can use the money. And so you're impacted by the change in the currency rates. Option one is just ignore that altogether, just focus on the trend, because the impact of the dollar is going to be automatically based into the ETF, because the ETF is traded in US dollars as well. If you were looking at an index that was like the Nikkei that was denominated in yen, then you'd have to worry about a currency conversion to get it back to dollars. But if you look at like the EWJ that's already trading in dollars, you're kind of already taking that currency impact out of the picture. So if you just focus on the trends, you're kind of covered. Option number two, though, is to remember that is to do some sort of conversion. You could actually hedge the currency out of a non-US bet. So buy a Japanese stock and hedge out the yen exposure using futures, using forwards, using ETFs. There's a lot of different ways you could try to do that, because there are ETFs that actually track the currencies. The third way, which is how I would think of it, is just keep in mind that if you own EM right now, even though the dollar is not directly impacting this chart, because the chart's already kind of calculating that with the dollar, remember that a weaker dollar most likely is going to make this chart go higher, because it's going to be better for non-US stocks or for you owning non-US stocks with a weaker dollar. If the dollar turns higher and starts materially improving from here, it's going to be a headwind for EM to improve on. So I found it's good as a sort of macro perspective. Stronger dollar, weaker dollar, okay. How much do I want to lean into or lean away from non-US exposure? Final chart, and then we have to move on. Our final question: can we create a Shanghai to S&P 500 chart looking at the performance of the two? Yeah, so it's actually, we don't have time to get into a full thing, but right now I'll butcher this chart that I have right now. I am looking at EM, and I'm looking at open, high, low, close bars. If you change this to performance, that's going to change the top half, looking at returns, percent returns from a starting point of the chart. You can see now I'm up 3% over that time. At the very bottom, add a price dash performance, say position behind price, and it's going to do, it's going to kind of start them both at the same starting point and look at the relative movements of the two relative to one another. So as a reminder, change your chart type to performance. At the bottom, add an indicator called price dash performance and put the ticker in there. You can do that with up to like 10 different things, I think, and look at relative performance that way. We need to wrap the show. Those are some really good questions. Thank you all so much for sending those in. We need to get to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the S&P breadth by cap tiers. You know, Tony was showing a chart of the advanced decline, like cumulative advanced decline line, and I totally get it. It's consolidating, and you could see a potential for an upside move. When I'm looking at breadth, one of the main ways I look at it is breadth for the S&P, breadth for the mid caps, breadth for the small caps. And what I'm seeing is the S&P move higher, small caps move lower, everything else is kind of in between. So you have this stoplight effect of the biggest companies looking pretty good on a breadth, on the breadth phase, kind of rotating back higher. On the small cap index, though, it's rotating lower. And so you have this divergence of large caps going upwards, small caps going downwards. That reminds me a little too much of sort of January to February, which was the, sort of an indication that there was this narrowing leadership, this divergence of sorts when you're, looking at breadth. So I think that's one thing I would be looking at for sure right about now. Chart number two is looking at the relative strength of consumer discretionary versus staples. I mentioned the chart of Amazon earlier and how it was holding up pretty well. This chart has actually evolved pretty quickly, where if you look on a cap-weighted basis, the trend has been positive for the last 4 weeks. But look at it on an equal weighted basis. So this takes the strength of Amazon and Home Depot out of the numerator. You're now showing this rotation away from consumer discretionary, more into consumer staples. It actually broke to new relative lows for the last 6 weeks today. So you're starting to see a less improvement in consumer discretionary, some improvement in some of the staples names. Might be worth looking around for some opportunities there if you've not looked at that space in a while. And then finally, the stock to bond ratio, similar to what Tony was talking about in terms of the rally and now this consolidation phase. I think Rick Benson here yesterday was talking about that range-bound nature of the S&P. And here you're seeing, if you look at the ratio of stocks and bonds, they're both actually holding up pretty well, which means the ratio is sideways, not clearly favoring one asset to the other. Folks, that's our show for today. I want to thank you so much for joining us on the Final Bar every weekday after the close. Special thanks to my guest, Tony Dwyer from Canaccord Genuity, for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.